Before we dive into how you should invest, we need to first address some common misconceptions around investing itself. These are that cash is king, no one can beat the market, Fomo, and loss aversion. Let's start with the biggest misconception that cash is best. Sure, cash is great for when you're buying your favorite clothes at the mall, but it's not so good at keeping its value. As we've addressed in the last lesson, varied costs like inflation and opportunity costs can erode the value of cash. If you kept $1,000 hidden under your mattress for 20 years, you'd only be able to buy an equivalent of $600 worth of stuff right now. Worse, had you invested that $1,000 at the start of the century into the S&P 500, a fund that holds the 500 largest companies in America, you would have had $5,000 at the time of this recording. That's a loss of 440%. What about keeping it in the bank? Well, the average interest rate for a savings account is 0.06%, while inflation is 3%. So you'll still be losing a lot of buying power year to year. Begging to ask the question, how much cash should I have? Most financial experts end up suggesting that you need a cash stash equal to 6 months of expenses. If you need $1,000 to survive every month, save $6,000 in cash on hand. The second misconception is that no one can beat the market. And in this case, the market usually refers to the S&P 500, which you can think of as the average stock market return. Well, for the majority of investors, that is true, but that doesn't mean it is impossible. Investors such as Warren Buffett and Jim Simons have beaten the market by a wide margin over the long run. It's not easy to beat the market. Let's get that out of the way right now. If a professional money manager is trying to tell you that because you can't beat the market, you need their professional help, chances are they can't beat the market either. And this is because over the long run, even most hedge funds, the investment vehicle for the rich, can't beat the market. The S&P 500 has outperformed hedge funds by a whopping 222% over the last 24 years. As Warren Buffett says, most people will be better off putting their money into the S&P 500. But if you have the grit, talent, and resistance against biases and fears, you might just beat the market yourself. Speaking of biases and fears, FOMO and loss aversion are two that cause us to behave irrationally and make bad decisions. FOMO stands for fear of missing out. It explains why we chase headlines and invest in often overvalued companies and why we don't want to miss the next big thing. FOMO causes people to lose sight of fundamentals, miss great opportunities, and only pick the most popular stocks. Another bias is fear aversion, which is a tendency for people to prefer avoiding losses over acquiring equivalent gains. We're often told to buy low and sell high, but sometimes we don't buy at the lowest possible price because we fear that it'll drop even lower. Another example is when we hold a good company, but sell the stock because of a short-term dip that ends up being just nothing. A strategy to avoid these two biases is to pick good companies and simply hold on to them through their highs and their lows, so your emotions don't cloud your judgment. Well, that wraps up our third video on misconceptions around investing. If you like the content, give us a follow so you don't miss the next episode. And if you want to see more, let us know. We'll keep making them just for you.